The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we take a look at the market trade after Wednesday's session, a bit quieter on Wednesday compared to Tuesday's session, where it kind of turned into a risk-off day across the board outside of cattle. Wednesday, we came back in a little more mixed activity we saw on the day. Joining us now as we talk about what's happening in these markets and looking at things and getting perspective into the new year, Mike Zuzolo with Global Commodity Analytics is with us. And Mike, always great to have a conversation with you. Thanks for joining us. Happy New Year to you and yours.
Happy New Year to you as well, Jesse, and all the great listeners and viewers out there with Market Talk.
Well, let's dive in. And as I kind of alluded to, a much quieter day on Wednesday, I would say, compared to Tuesday in terms of the market action. We tried to eke out a little bit of green on the screen and some of the grains. Overall, I know we got a lot to dive into today. Just your general thought here as we kind of started the new year with a bang to the downside and then quieted it down a little bit on Wednesday, Mike.
Yeah, I like the way you frame that because there was a big distinction between Tuesday and Wednesday, and I think the big distinction was the crude oil market. Both days we saw the dollar higher. That's a safe haven bid, I think. That's a fear of a weakening demand base. I think the freight shipping issues are really starting to bother the global demand bulls out there for commodities overall. And front and center to that is the crude oil. And that was the difference between Tuesday and Wednesday's trade, as we had a sharply higher move back to above $70 a barrel in crude oil, realizing Tuesday, we're still, trying to catch up from what we lost on Tuesday because we started off about 2.5% higher on Tuesday and then shed almost 2%, if not a little bit more than that. So we had a net range of almost 5% on Tuesday's trade, ending very poorly in the crude oil market. And so I would say at this point, Jesse, we're at a point in the 2024 grain markets right now, and livestock for that matter, where we're picking up where we left off in 2023. We don't have the weather to support us as much. And so as a result, the bean bulls are getting out. The hard red wheat bears are trying to push their idea that the crop is getting better and better. And that's why we took out the December lows in hard red wheat. But I really think the heart and soul of this market in terms of a grain turnaround is got to be matched up with the Asian markets, China, i.e., and then this crude oil market.
Well, let's talk a little more about crude here. And I pulled up the lead month chart for WTI crude and walk us through what you're seeing here. I know I heard a little bit of scuttlebutt about the Strategic Petroleum Reserve as well, I believe, on Wednesday, and maybe some things there. So talk about this a little bit more in terms of what's going on with this crude oil market right now.
Yeah, this is a 2024 outlook all boiled into two lines on this chart, and that's the undervalue line and the overvalue line. These are the prices I see as essentially too cheap and too expensive. And I'll say right up front, as I prepare more of my 2024 value level analysis, soft red wheat and hard red wheat are going to look a lot like WTI in that we are at or below what I think is undervalued, both in terms of where I think we are in global production versus global consumption, and where we are in terms of how the funds have acted the last 3 to 5 years. And I try and blend those together, that funds versus fundamentals. And so the question would be asked, why are we making new record highs in the Dow Jones Industrial now? Why did we make new highs in the S&P a week or so ago? Why are we seeing some of these risk-on mindsets in gold and Bitcoin? And yet the crude oil just languishes there with the worst geopolitical situation we faced, in my opinion, in 20 plus years. So this is where the undervalue level comes into play. And if you're looking to get into the diesel lock on the winter, looking to get fuel locked in, natural gas locked in, I think that this is the time and the place that it could be a very good point to do, because we are at undervalue levels. We're on Wednesday's close, only about $5 away from the 6-month low made about 4 weeks ago. And I think that's the key in this market, is I think we're in pretty substantial undervalue territory in the geopolitics. The fact that Saudi Arabia and Iran just joined the BRICS today, The fact that the Middle East is heating up, in Iran more, in the Red Sea more, I don't think these prices are justified and warranted right now.
A lot of geopolitical risks out there in this crude oil market. Great thoughts on that. I know on the flip side of this too, we look at crude. We got weather though. That's still a major issue. Not only looking at the U.S. drought monitors, we're getting thoughts together for planning a 2024 crop, but we're watching South America too. So let's look at weather as a whole. What stands out to you here, Mike?
Yeah, we only got our Santa Claus rally essentially in the wheat. The row crops did not give it to us. And so there is a disconnect here. And this is why I go back to the demand side of the equation. My mindset is always, if the markets are breaking into new lows or going down to major lows, it's because of demand fears. They don't care much about supply. So this goes back to this seasonal drought outlook that USDA gave us, or excuse me, NOAA just gave us on December 21st. And, we're right before the holiday. We really haven't traded this at all, because in this seasonal drought outlook, and it doesn't mean it's going to be right, but the fact is that yellow area is where the NOAA people think the drought development is going to be likely. And notice how Iowa, Kansas, Missouri stay dark brown, and then we start to increase the drought in their view in northern Kentucky up into central Illinois, the rest of Indiana, and almost all of the key farm country, corn and bean country of Ohio. And I think between this, Jesse, and some of the South American weather that's still out there that we haven't really traded and priced in, this puts more burden and more pressure on the January 12th crop report.
And looking too at the southern hemisphere, that's another key issue that I think we've been talking about, but maybe, as to your point, haven't quite priced in to these markets yet.
Yeah, this is a pretty high level piece of analysis that I pay for, and where the red arrow is, this is reflecting the southern hemisphere corn drought stress done by this organization. And they're using a 5-7 year historical band, and then they have last year, and then they have the 5-year average mixed in there as well with the orange and yellow lines. And so you've got a couple of years you can look at definitively, and then you've got the trading bands of 5 years and 10 years. And we're up there in the very top end of the 5-year and close to the 10-year top of drought stress in the southern hemisphere right now. This was just updated today. I got in touch with them to give me a fresh update for your show, and they just updated it today. Yes, there's better weather coming for center west Brazil, but I think this is why another private analyst came out and slashed yesterday their supply side, their production side for Brazil, taking their crop and the beans down to 152.8. That's actually below mine by about 1.3 million tons. And they took their corn crop down to 122.4. That's going to be about 4 million tons bigger than me still. And this is the main reason why I am at the 118 level and sitting right there with CONAB, because in part this indicator. So this is, again, where between that drought monitor that we just looked at and this stress index, I think we haven't really adjusted to a new lower supply bias coming in this next 10 days with that January 12th crop report. So I'd like to see the supply and demand hook back up after that if USDA does indeed cut the supply more than the demand and kind of retools what the trade is thinking. And I think this is the big issue with the black box funds right now with these algo fund traders. It seems like they choose one side or the other when it comes to how they price this market in. And that's why they use the momentum and sentiment indicators so much.
Yeah, and that's a great point you make. It feels like plenty of fund activity here to begin the year ahead of this key USDA WASDE report out on the 12th. And Mike, as you know, and many folks know, and we've talked about it and alluded to it, this report is always a very big report and contains just a whole lot of data, doesn't it, Mike?
It does, and you get what you think are going to be the final numbers for U.S. corn and bean yields, and you could still see some movement in the supply side when it comes to the wheat side of the equation, because especially of spring wheat and durum, global numbers can move all over the place, and I think all of those are on the table right now. I'm not so sure we won't see another little small cut in the yield side of the equation for corn and maybe even beans, just because of the way things finished up here this year in this country.
We're having a conversation today with Mike Zuzolo from Global Commodity Analytics. Mike, let's dive a little more into corn and soybeans here, and I'll pull up another chart on our video feed. You're looking at lead month soy corn ratios here, and I know that in the last few days we've seen plenty of chart moves here between these two markets. Obviously, you roll the calendar over to a new year. That could lead to farmers selling with a new tax year and more. So I guess just to start, walk me through kind of what you're seeing on this chart right now.
Yeah, the premise of this chart is in the front end is to see exactly what the trade is feeling from a standpoint of we didn't get our Santa Claus rally in corn. And if we're not going to get a Santa Claus rally in corn, and I've just gone through a couple of reasons why the corn doesn't have a weather premium in it compared to the beans, then the beans are probably going to leak, and they're probably going to find a big hole at the bottom of the bag that they're going to start letting go of some of their premium. And that's indeed what's happened here now that we've gotten into the end of last year and in the beginning of this year. And so we see this break back down in the bean corn ratio to 2.74 after sitting up around 2.85, 2.9 for the better part of the second half of 2023. This hasn't translated as much into the new crop, though, and that's where if we look at that chart in the new crop beans divided by the new crop corn, then we see that we saw a bigger break from about 2.52 beans minus corn, and I have that written backwards in the title, so it's beans into corn, but bean corn ratio is now at 2.47, and that was during midday today, Jesse. That suggests to me we're starting to look towards trying to buy more corn acres back, and I think as you get down to 2.4, 2.42, you really start to press the throttle up to get farmers to plant more corn, and that's the problem with this market. If the beans don't go up, the corn's going to have a hard time staying above $5. And so that's where this situation on the January 12th crop report becomes so important. I really would like to see the corn and the wheat take charge here and come off their undervalue levels and support the beans at this $12.75, maybe even get back to $13 in the new crop side of the equation.
Well, thinking about buying more corn acres back too, your thoughts here as we kick off the new year, and you think about regional basis opportunities and more. We're seeing a lot of farmers selling. We got a lot of corn in storage, Mike. We've talked about that from this recently harvested crop. Are we seeing a lot of movement here early on in this new calendar year, or not so much yet?
No, we are. I think that's one of the universal things that I am seeing, because producers are calling in and saying, I've got to let some cash go. Some basis contracts are starting to creep in on me with this futures break, and I'm going to need to do some cash flow here. And do I need to re-own it here on the board? And that's, I think, a really good idea, generally speaking, in a known cost manner. Right now, I would explore unlimited risk once I saw those January 12th crop report numbers, or if I did a futures, maybe put a cheap put underneath me as kind of a stopgap, so you didn't get completely trounced if we would go cash. The market would cash out and go straight limit down. But one of the things that I'm hearing also from the producers, it's important, I think, Jesse, is I had a good conversation with an Indiana producer today, and he said, I did my cost of production on corn, and I'm sitting at $500 an acre. That's with light fertilizer, not counting, obviously, my cash rents. And if you're running a $250 cash rent, you've got another $50 to put on in terms of fertilizer, like this guy probably will need to do. You're up to $800 right now in cost of production. And that's why the beans look so good. And I think that's why that bean corn ratio becomes so important now, and especially after the Jan crop report, because then we turn the corner, start factoring in the new crop insurance prices as we get into February.
All right, let's switch over to livestock. We think about where corn prices are a little cheaper. It might be good for some of our feeder folks. We had a really strong day on Tuesday in both fats and feeders. A little more mixed activity Wednesday, but walk us through this feeder fat spread chart that you have right now. What are some of the features you're seeing in the cattle complex?
Well, I had a lot of angry cattlemen today because the models have turned colder, and that was late last week, and the trade hadn't really caught up with that yet. Now they've turned wetter, and that means snow. And the GFS model is putting a couple, three big snow systems in the plain states. And this is the GFS model here, and it's picking Kansas. And you're looking at Wichita, Hutchinson, 20 inches of snow. Now, this is going to run hot. I think it's a heavier amount just based upon watching these year in and year out in the wintertime, especially in the early winter when we turn from warmer to cooler. But the updated European model also shows 15 to 20 inches, but it's more in the heart of Omaha. And so it's, instead of Kansas City, it shoots the major part of the storm about 200 miles north. So both major models in the next 7 days are putting down a lot of snow. That got me to look at that feeder fat spread that we have here. And we typically can bottom in the feeders minus the fats in Q1, Q2. Essentially the last 7 years, we would carve out some type of low in the feeders and against the fats. Between what I'm seeing in the cash feeder market right now and between this winter weather and, as you point out, the weaker corn prices, I think that's something to really look at here if you're working with me in terms of a brokerage side of the equation, and maybe a spread trade where you come into the long feeder, short fat mindset in, say, the March futures for the feeders.
In terms of the funds too in this cattle market, I know we've watched some of that fund money move in and out here, and as we start a new year, I wonder if, depending on where things lay, if we could see some of that managed money maybe move back into these cattle markets. Mike, what do you think?
Yeah, that's a really great point too. I mean, they were net short 2 weeks ago. I didn't look at their most recent number. I had meant to do that, but I think they're still net short at this point, if not even. And so I think there's a lot of room for them to jump back in. I'm encouraged to see the December fat cattle market jump when it expired, and it closed up near 174. That really gave the fat cattle market a chance for the February lead month now to really try and shine. And I think that's where, again, like the grains, we essentially picked up in 24 where we left off in 23. Cash fat cattle, I think, could establish themselves this week finally with this winter weather pattern. And because I think the Packers, even maybe they're cutting in the red, but I think they're going to need to really get some movement going here if we have kind of a really hectic January winter, which we were not expecting. We were expecting a warm January and then to turn colder in February. So if the fat cattle can play along, that even adds maybe a little bit more upside to the feeders in terms of potential recovery. Still not off that 2014-15 mindset, though, Jesse. I think this is still the opportunity to get rehedged heading into the springtime, especially given the equities markets, the dollar, and the hog market.
Speaking of that hog market too, hogs kind of churning around down here at low prices. Prop 12, we got inspectors out for Prop 12. The rumors are already across parts of the country, even though it doesn't technically go into effect fully until the summer. I have to think, though, that's maybe having an effect here. This hog market just remaining pretty dismal here as we start off the new year, Mike.
It is, and I think, Prop 12 is mostly about California, but as you say, it does get into the other parts of the country, especially if more laws get thrown out there. So I think we've got most of that Prop 12 issue factored in. We've got the Deese Hogs and Pigs report showing liquidation pressure. I think most of that's factored in at this point because I am now hearing pretty normally and pretty regularly, unfortunately, hog producers getting out for good because they're in their 50s, 60s, and they're just not going to lose and burn any more equity at this point after a dismal 2023. I think they see the writing on the wall. It's just not worth it because it's going to take years to make that back in their minds. I think the big thing still is China. That's probably the biggest issue as far as the bottom falling out of the hog markets again. So I'm hopeful that the Chinese leader is very nervous about his position and his leadership. I'm very hopeful that he moves on the economic front and he moves on the trade front as well. So we'll keep an eye on those export sales.
Mike, final thoughts real quick before we let you go. Anything you want to mention or reiterate today?
Yeah, great time to take a look at the website, globalcomresearch.com. I just posted 2024 product services and kept all my prices the same. I just posted a new subscription deal for 3 months for $100. You can sign up there. Please take a look at our analysis. I think it may be a really great time to take a look at what we do and that independent research we do and keep track of those value levels and get to know those value levels and see if they don't work into your operation.
Globalcom with two M's, research.com. With that, Mike Zuzolo, Global Commodity Analytics. Always great to talk with you, my friend. Have a awesome rest of your week. We'll talk to you next week.
Thanks, Jesse, and Happy New Year again.
And Happy New Year again to you as well. Mike Zuzolo with Global Commodity Analytics joining us here today on Market Talk. Let's go do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.